Hello and welcome to PFI Talks, brought to you by Prague Finance Institute, an affiliate of the leading Czech economics research center CFA. My name is Zelof Partners and I'm the head of communications at PPF Group and the host of this podcast. This is a very special edition of our podcast because we have a very special guest. It is my pleasure welcoming Chelhot, who since the 1st of October become the Chief Economist of the Prague Finance Institute. You may have not heard about Andrej, so now is good time to listen. Hello.
Hi, how are you? Thank you for the invitation.
Well, when we look at your LinkedIn profile, I mean, you studied at the University of Montreal. Sorry, I'm just using not probably a proper English translation of that French, esteemed university. And then you immediately started working for the Bank of Canada. How did it come about?
Well, when you are doing a master's in economics, and especially in monetary economics and international economics, you have three options after you finish your master's. One is to go to the private market and to work for a bank or to work for a fund. The second option is to go into the public sector. And the best options that you should choose were the Central Bank of Canada or the Ministry of Finance. And the third option, when you finish your master's degree, is to go and make a PhD. So I did not tap the private market because I was very interested in research and to understand policy. Mm-hmm. And going from master's degree immediately to the private market will not achieve this goal. The third option, the PhD, I thought that it would be a waste of time because if you go to the Central Bank of Canada and you spend 4 or 5 years over there, you will have a better degree than a PhD.
Okay. It's the degree of the Central Bank of Canada.
Definitely. And over there in the Central Bank of Canada, I think I got the best training ever in macroeconomics and applied macroeconomics, where they make you apply what you have learned in theory on the ground. And of course, they have an extensive database. Actually, they collect all the data on money, on credit, on interest rates, on FX rates. So I started as a research analyst in the monetary and financial affairs department. And back then I was part of the team that was building or was taking care of monitoring the aggregates of money supply. And I remember that we came up with a new money supply aggregate, which we called M2++ or M2+. I don't remember exactly. And actually it was the idea of myself and some colleagues, because we noticed back then when we call it the disintermediation of the financial market, something like that the banks and the brokerage firms, they were allowed to separate. And then suddenly we started to see a lot of money escaping the money supply, the definition of money supply back then, to money market funds and mutual funds. The money market funds were very interesting because you could have 100% guarantee of your money to be returned back, like a deposit in a bank. So what we did is we said, well, there's a lot of money, we don't know where it is, just vanished, where is it? So we went to look into money market funds and we started collecting data from the biggest money market funds, and we added the money market funds and some mutual funds, not all of them, the fixed income and especially the short term fixed income funds to the money supply. And we came up with M2+. And it seems, we proved that M2+ had a better correlation with the business cycle, be it GDP or inflation. And since then, M2+ is regularly published by the Central Bank of Canada, And it is one of the few countries that has added money market funds and some other investment vehicles, short-term and guaranteed, to the money supply. That was the first experience. The second experience is that what I gained from there is very interesting, is that I was participating in the process of auctioning the government bonds and the government treasury bills. And we were also very involved in the intervention in the overnight market and also in the FX markets. So there we learned how central bank policy is actually implemented in the markets. It's very interesting because, some people, they get very, very frustrated. On the other side of the trade, you are the central bank. You are like the king of the market. And it's very interesting to see what banks are expecting from the central bank, if they get it or if they don't get it. Lots of speculation, for example, was happening when the central bank is going to cut rates, when they're going to raise rates, what we're going to do with the size of the auction, because also it's very important for the liquidity management for banks and for big funds, especially big government funds. So that was, for me, as I told you, way better than a PhD.
And maybe you may end up actually being taught. There may be a chapter in some economics, seminars about M2+.
Definitely. Well, to talk about that in the central bank back then, they were forcing employees who are in the research departments to take regular seminars and to produce research papers with the help of or with the collaboration of some universities, like University of Toronto, University of Montreal, University of Ottawa. So we were always connected somehow to the universities. And this is a very normal process because the central bank and the Ministry of Finance in Canada, they hire their staff or the new talent. They go to the universities and they look for them.
But nevertheless, in 1997, you jumped ship, so to speak. You actually left the perceived safety net of the Central Bank of Canada, went into the commercial sector, and you started working for the Olayan Group, a shall we call it a privately held investment company that actually has its roots in Saudi Arabia. So maybe a little bit of in the energy sector, and energy is big in Canada. Was that sort of a link between you and the Olayan Group, or how did that come about?
No. When I was at the Central Bank of Canada and we were trading in FX and interest rates, a coverage of our account, a gentleman from Goldman Sachs, I remember, from New York, he calls me up and he says, there's a sizable fund who is looking for macro strategists to understand macro, to understand fiscal policy, central bank policy, and if you would like to give it a try. So I was on my way to Dubai to visit my cousin, and I came to Athens because the head office of the Olayan Group is in Athens, although they have offices in London and New York. I'm not sure if the head office is still there, but anyway. And I thought back then, and rightly so, that I can take what I learned from the central bank and from my studies and build from scratch an economic research department for the Olayan Group, and then start trading macro, which was mostly an overlay strategy, let's say, of the huge balance sheet that they had.
Well, you stayed there for quite a few years, but then it seems like that around, and correct me if I'm wrong, 2018, 2019, you might have decided to take a sort of career break from high finance and economics, and you started investing into vacation Greek real estate. Now I understand why, because you were in Greece, so you obviously like being there. And But what was really driving you to actually make that shift? Or is it a shift?
Well, when I left the group, tell you the truth, there is a reason why macroeconomists back then in 2016, 17, 18, their career was not going well. For a very simple reason is that everything was going up and money was flooding the market. I mean, you had QE, you had a zero interest rate policy of most central banks around the world. The US started raising rates, I think, in 2017, 18, after 8-9 years of zero interest rate. The ECB the same. The Swiss National Bank was lending you money at negative interest rate. So not only at the group, but also outside the group, the function or the role of a macroeconomist, macro strategist was becoming obsolete. Mm-hmm. And because of this particular period of time that we lived, and it was a fact. We didn't need you. We don't need you. Mm-hmm. Everything is going up. So because a macroeconomist or a macro strategist is a person who's going to make relative value trades, comparing. If everything is going up.
Or if everything is zero, what do you have to compare?
Exactly. And I realized that I was in Greece, beautiful country, very cheap, in the middle of a crisis, and real estate is like so cheap. So we decided, myself and some friends and family members, to invest in Greece while everything was going bad. And we made a hotel in the island of Mykonos. We have also some other villas over there. We have in Antiparos. We have some Airbnbs in Athens. We built a hotel in Athens and we sold it. And also we invested actually in Montreal and in Miami during these years where, things were not going very well. And, fortunately our bets paid off. And thank God we are doing well.
So that would explain what seems like now sort of returning to your career, how you started. And is it because now not everything is going up? Now it's actually sort of like there are a lot of question marks where we headed, and we get to that later in our discussion. But so last year you joined Zelof Partners, if I'm pronouncing it correctly, which is a boutique investment advisory, and also you decided to join the Prague Finance Institute to become the Chief Economist of Prague Finance Institute. So what do you do now, and what brought you to the PFI? What actually made the connection? Where's the connection to Prague and to PFI?
Okay. Let me start by saying something here, that after COVID, or during the period of COVID, I wrote something on LinkedIn, small sentence: macro is back. Okay. And back then, a lot of people, they say, what are you talking about? Macro is back. Yeah, macro is back.
Was it just that one sentence, just one post? Macro is back.
Macro is back.
And you knew, based on your followers, you knew that people would understand who is saying it.
Yes. And my friend Nabil from Zelof, I know him for 25 years. He used to work for Goldman Sachs, for Merrill Lynch, for Barclays. He used to cover me when I was at Olayan. And when he saw this post, he says, Andre, you are very right.
Post, 3 words.
3 words. Macro is back. Why don't we do something about it? I said, okay, what do you have in mind? He says, we at Zelof, we are a small boutique. We have a platform of funds, but we don't have anyone to talk on our behalf about macro strategy, about global developments in macroeconomy, about geopolitics and their impact on the macro economy and the global economy. By the way, I have read something very interesting recently, is that before 2020, it was economics that were leading geopolitics. Now it's the opposite. It's geopolitics that are affecting global macroeconomics. And if you don't understand what's happening in geopolitics, it's very difficult for you to understand what would be the policy reaction, be it monetary policy or fiscal policy, because lots of people, they say, well, central banks are independent. No, they are not. They are looking at geopolitics. Yeah. When the oil price goes up, central banker is like watching it. So to come back to Zelof, yes, we started with Zelof to be their advisor on macroeconomics and geopolitical developments in the world, and how to translate this research or these views on the market. Mm-hmm. So we believe in a very simple theory, which is called regime shift. Mm-hmm. And during regime shifts, you go through, it's a transition. And during this transition, you're going to have a lot of volatility. And funds, especially hedge funds, they love volatility because this is how they make their money. So we started this way. And then we started posting regularly on LinkedIn, not our research inside Zelof, but some charts that makes you go, whoa, what's this? Mm-hmm. And this is how we got in touch with PFI. Mm-hmm. And we decided to start something that similar to what we have started in Olayan, but non-profit, to disseminate research on global economics, on geopolitics, and to do podcasts. We're starting with you, and to do courses for graduate students. Actually, PFI is now sponsoring 2 students, one that has already started in London at LSE, and Zelof and Partners are taking the task of training the gentleman. I'm taking the part of macroeconomics, mm-hmm. and my colleagues at Zelof and Partners are going to train him on
so it's going to be combined with that person's, university studies and an internship, exactly, and sort of a mentoring of you and your colleagues at Zelof. Okay,
true.
Let's shift to the regime shift. Yeah, I mean, it may get confusing. People may talking about political regimes, so we're talking about more sort of monetary regimes. You are referring more to a macroeconomic regime, but the geopolitics is still sort of lurking behind it. Is there a way to briefly define what you mean by regime shift?
Okay. So let's put it this way. I'm going to open many subjects in the same time to come back to the core subject, which is regime shift. Let's start by the fact that the United States is an empire, like Britain was before the Second World War. If you look throughout history, empires, the Roman Empire, the Persian Empire, Egyptian Empire, Spanish Empire, Portuguese, whatever. Empires, they don't produce. They consume. Empires conquer, and then they consume what the countries that were conquered produce. I mean, you go back to the British Empire. They conquered India and the other countries. They created the Commonwealth. And most of the British economy was produced in these countries. So after the Second World War, we have the American empire. And the American empire is consuming, is not producing. Now, empires, they keep control by maintaining the supply. Let's put it this way, of two essential inputs. One is energy and raw materials. Two is labor. I truly believe that around 1972, 1973, 74, there, after the 1973 war or around it, the US managed to get the first one. When they started pricing oil in dollars, they took care of the first one. Because if you have the most needed energy source that is priced in the currency that you control, so you are controlling the denominator. Yeah. Right? Once you control the denominator, you control the ratio. So that was done in the 70s. And the second part comes in 98, 99, 2000, where you had two major developments. One is the creation of the Eurozone, and two is the entry of China in the WTO. So, what they have done is that they secured the second part, which is labor. So, you had a situation where you are in control of the energy market, then you are in control of the labor market, not necessarily in your country, in another country. So you had the 20 years, that agreement was in place. You had 20 years of low inflation, open trade, we call it globalization, and a kind of a control over the price of energy. Now, of course, the price of energy was going up and down, but it's the US government that decides the price of the dollar, right?
Hence the value of petrodollar.
Hence the value of the petrodollar. So we had 20 years of low inflation, free trade, open trade, and that resulted in a kind of a confusion. And I'll tell you where is the confusion. Is that central banks suddenly they said, we are like heroes. We are pursuing price stability. If it was not for us, we wouldn't have had price stability. I think this is not true. I think that central banks were lucky. It's the environment that was in place where you had a positive supply shock one after the other that have allowed inflation rate to go down all over the world. So you were capable of lowering interest rates. And then, if you want, we can talk about the consequences of this policy. So these 20 years, they are behind us now. And if you look at the world and you see, one, you have a threat on the first part. You cannot anymore force countries to price their oil exports in your currency. You try to do that by other means, by threatening these countries, by taking them out from the SWIFT, from whatever. But at the end of the day, the fact is that they succeeded in turning around and then trading with each other without the need of this currency, which is the US dollar.
But since we are off the gold standard, the only really properly deep and diverse financial assets market is still the US dollar.
I totally agree with you. I didn't say that this is going to succeed. I didn't say that, another reserve currency is going to come out and succeed all of a sudden and be the next reserve currency. I agree with you, because in order to have a reserve currency, before you have deep financial markets, you need to have what we call a right to private ownership. If you have a certain wealth and you want to make sure that you're going to maintain this wealth, you want to invest in a country that is going to respect your investment and is going to give you a chance, or an access to owning inside that country an asset. We don't see that happening in countries like China or Russia or even South Africa. You're not sure. You go and invest in China, maybe in 10 years' time or 5 years' time, somebody comes out, says, well, you know what? Sorry, no. So that's before the deep financial markets, is the rule of law. But nevertheless, you will still have rogue countries, and I mean rogue relatively to the US. I mean, in absolute terms, maybe they don't see themselves rogue. Yeah. But you will still have rogue countries that are trading now between each other and trading not in the US dollar. Indians, for example, are buying Russian oil in rupees. The Chinese are buying Iranian oil in yuan. We have now a possibility that China will buy Saudi oil in yuan. So yes, the yuan or the Saudi riyal or the Russian ruble will not be able to replace the dollar as a reserve currency. But then you're going to have one part of the world that is relying on another system. Now, it is efficient. Okay, it's not efficient. It doesn't change the game. The game is that the dollar is not used as much as before by these countries. So regardless of the success of the second or replacement reserve currency, the impact on the US dollar is not going to be mild. So we are now talking about the second part of the equation. I told you the control of the energy prices, then the control of labor. The thing that amazes me actually is that, when you learn about trade in economics in the university, trade is supposed to be both ways. This is the theory of comparative advantages. So I'm good, for example, in making cars. You're good in making chips, let's say, electronic chips. Okay, great. So my role is to export cars to you and import chips from you. And the other side is exporting chips and importing cars. What we have observed over the last 20 years is actually not what was supposed to happen. What we saw is that, and we come back to the empires that consume, what we saw is one block of the world is exporting and one block of the world is consuming. And that has created massive external imbalances between the major economic blocks in the world. If you look at the net international position of the US, it's almost 70% of GDP. It's like $23 trillion negative. If you look at the NIP of Germany or Japan or China, they are the opposite. So these massive imbalances, they were not supposed to exist. But they did. Now, I'm going to ask a question rhetorical question. let's say that you are the Chinese government and you are sitting on a FX reserves of like 1.2, 1.3 trillion. Now they are about 800, 900 billion. And you have credit lines, or like, you sold whatever. You sold to the US, and the US government or the US economy gave you a paper, a piece of paper. That paper is called the dollar. They didn't give you gold, they didn't give you silver. They gave you a paper. There is a point where you don't believe in this paper anymore. Not because the US is going to default on its treasuries or on its debt, but maybe the US is going to continue on printing this paper. So these imbalances, they cannot grow forever. At some point, people, they're going to start questioning, like, when I'm going to get, not my money back, but when I'm going to get what I'm owed as production. I have produced. You give me a paper, okay, what I'm going to do with this paper? Do you allow me to go and buy, for example, an oil field in the US? If you do, yes. But if you don't, we have a problem. And now, since 2016-17, with the coming of President Trump, that equation has changed. I'm not going to give you anything for that paper. Go and buy something else in the world. Me, I'm not going to give you anything. Once you lose that trust between the major economic blocs, then you lose the labor. So what is happening for the last 3-4 years is what we call reshoring of manufacturing activities. If you look at the data, you see, for example, like, the share of imports from Mexico, the share of US imports from Mexico, of the total imports of the US, is going up, while the share of imports from China is going down. And actually now Mexico is bigger than China as a trading partner with the US.
May I just interject? Because I don't think we're going to cover everything what we set out to cover. Because this is very interesting in and of itself, this discussion. Because what you are alluding to, there is nearshoring and maybe some discussion about reindustrialization of the West. What do you think is going to happen? That's my question A. And B, what from the perspective of looking at assets from like the macroeconomic, sort of macro look at investments, how should I play it if I were to sort of decide about my investments, my portfolio? Should I be buying old factories in Ohio? Or should I be rather betting on nearshoring and really investing and putting everything in Mexico?
Well, I think that the more you go local, the more you are protecting yourself. Now, it is true that we have a reindustrialization process that is going on. And I think that an investment in that sector is a good investment. Now, when you talk about Mexico, Mexico has a free trade agreement with the US, and Mexico is on the border of the US. So when you invest in Mexico, I think that you are investing in the US with, on the top of that, an exchange rate risk. But that is manageable. So Canada, Mexico, Latin America, for me, it's a US play, US game. What I'm worried about is the situation in Europe. Because in Europe, the difference between Europe and the US is that the Europeans, they don't have energy. The US, if you combine Canada, US and Mexico, all three together, they are energy independent. The Europeans are not. So, unfortunately, with the war that is going on, the Europeans have lost access to energy. And to reindustrialize a country, the first thing you need is energy. Second thing that the Europeans lack of is actually labor. High-skilled labor. So also with the sanctions and the trade tariffs that are going on between the West and China and other countries, also labor is becoming limited. So to answer your question, I would invest in industry in the US. I would not invest in industry in Europe. And we are starting to see actually that the German car industry is suffering a lot. And other industries in Germany and France that rely heavily on energy, they are also suffering a lot, to the point that some German big companies like BASF, they moved. They went to places where they can have access to energy and access to labor. So yeah, I would invest in America and all the countries that are, we call them the satellites of America, but I would avoid to invest in European industry.
Well, I mean, okay, this is a very gloomy picture. Let's not try to end our discussion on that. Just recently, there was a debate. I know it's coming from a relatively small party on the German political scene, CSU, CDU. They are talking about like stopping the process of shutting down all the nuclear power plants. So maybe this will be the way for Europe to sort of like get back their access to energy. Because, I mean, there is an example. I mean, Japan. Japan is a very successful economy, very, not a lot of energy available. They have to import everything and they still rely on nuclear energy. So maybe that will be the way for Europe. But in terms of Europe and the clock ticking, how much time do you think Europe has?
I cannot answer that. How much time they have. But what I think is that now we are diverging a bit from the subject, but it's very interesting because I think that you cannot have a monetary union and a quasi-fiscal union without having a political union. This is like scratching your head like that. Mm-hmm. You cannot do that. First, you have to have the political union. Then you implement the fiscal union. Then you implement the monetary union. So when someone wants to answer your question, he needs to know or speculate when this monetary union is going to break. Mm-hmm. To answer this question, I mean, it's very sensitive, also delicate. Politicians in Europe, they don't like to hear this kind of conversations and all this subject to be debated. But at some point, when you're gonna have so much imbalances between the North and the South, and inflation is sticky. Now it has come down, but I think it's gonna be going up again, and it's gonna be sticky. Well, it's easy to bail out countries when you have deflationary forces, but it's not easy to bail out countries when you have inflationary forces. How it depends how much the Germans and the other Northern European countries are willing to continue on taking the tab of the Southern countries. I think that what's going on in the society in France or in other countries, the frustration of the population, especially the low-income layer of the population, is an indication that this system is not very viable in the very long term. Now, if they manage to make a political union, then I would say I'm wrong. They managed to make a political union. Europe has become one country. But unfortunately, I don't see it. coming.
Moving on, and that's my last question. When it comes to your involvement with the Prague Finance Institute, so what should we be looking forward to from you? We should be reading more sort of research materials, or there should be more mentoring, or will you even consider taking on a course, even if it's online?
Yeah, okay. So what we are planning to do with the PFI is one, to do research, regular research. We're going to produce a monthly letter. We're going to make some podcasts with some prominent economists and geopolitical strategists. We will also train young graduates. We will make also a course in macroeconomics and monetary economics. And we will do some charts of the day to gather some thoughts, let's say, in the market about some important subjects. And we are hoping also to do brainstorming seminars. I think that it is a very exciting venture that we're going to do together. And I'm very, very pleased and very honored, by the way, to be joining forces with the Prague Finance Institute.
And maybe one day we can actually sort of look forward to an offsite at one of your hotels on the Mykonos island.
That is a very, very good idea. And actually, I mentioned that to the PFI, and we are more than welcome. We would love to have you over.
Says André Chelhot. Thank you very much.
Thank you.
And to our host, thank you for being with us. And thanks for being very patient listeners. And now we know that you have a lot to look forward to. So thank you for tuning in, and stay connected. Bye.